bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the February 20th, 2024 podcast. I'm very pleased to have my partner, Aaron Sherrard, with me this week. He's joining me to talk about state-level low-income housing tax credits. State-level housing tax credits are increasingly popular across the country as more and more state legislators and governors seek ways to increase affordable housing production and renovation. More and more states are recognizing the key role that state housing tax credits can play in closing financing gaps so that developers can move forward on projects under development or with planned renovations. Let me share some numbers. 10 years ago, 13 states had their own version of the housing tax credit. Today, as I speak, there are 30 states with their own version of housing tax credits. That's more than double the number from 2014. In today's podcast, we'll focus on some of what you need to know about state housing tax credits. As state housing tax credits can vary or do vary in many ways across those 30 states. For instance, the term of state housing tax credits can vary. They can match the federal credit of 10 years or be shorter, such as over 4 or 5 years. The amount or the annual tax credit percentage varies. The manner in which investors access the state housing credit can vary also. There are two general approaches, which Aaron will explain later in more detail, but the two approaches are allocated and certificated credits. Allocated credits are where an investor becomes an equity partner in a partnership and is allocated the credits as in a partnership level allocation, just like income and losses are allocated. This would be an allocation of those credits. And then there are certificated or transferable credits, where an investor buys the state tax credit similar to buying property, with a state tax credit being transferable intangible property in this instance. And speaking of investors, the types of state tax credits that a housing credit can offset often vary. Now, this episode is the latest in our podcast series called So You Want to Be a LIHTC Developer. The series is designed to help real estate developers learn more and better ways to use the low-income housing tax credit to fund the development and renovation of affordable rental housing. Now, before getting to Aaron so he can share his insights, let me make one last note. My January column in the Novogradac Journal of Tax Credits was written about the effectiveness of state credits in helping finance a variety of community development activities and projects. I will include a link to that article in today's show notes. And there's a lot to talk about, so if you're ready, let's get started. Aaron, welcome to your first Tax Credit Tuesday.
Thanks. It's great to be here.
It's great to have you here, and I hope after this podcast, you'll come back for a future one. But before we get started talking about state affordable housing tax credits, I wanted you to start by sharing with our audience your role at Novogradac and some of the services you provide to Novogradac clients.
So I focus primarily on the low-income housing tax credit. I work with developers, syndicators, nonprofits within the industry. I perform annual audits, including those properties receiving HUD assistance, tax returns, final cost certifications, and consulting throughout the life of all those entities.
Knowing that's what the services that you provide, I should also thank you for making time during the heart of busy season for this podcast, and I'll thank you on behalf of our listeners as well. So in the introduction, I talked about state housing tax credits and their role as a source of gap funding. And I wanted to get you to share some of your thoughts on the rise in the use of state housing tax credits and some of the ways state allocating agencies often use state housing tax credits.
So it's become a very significant gap funding incentive that the states are using. They are becoming increasingly popular in the last few years because, again, we have inflation that's increased construction costs that the projects are incurring. You have interest rates have increased, and that's add additional cash demands during construction and during the operations throughout the tax credit period and beyond. And as you mentioned, more and more states are adding state LIHTC credit programs as it has become a needed source in that capital stack. So state tax credit agencies have realized it's a necessity for for the state to have these state LIHTCs in order to get certain projects financially viable to have the state, that are in their pipeline and waiting to get those projects done to meet their current needs. So this is why you see a lot of states have LIHTC programs that will set up to help deals that usually have larger funding gaps or that operate, say, on smaller margins due to the populations that they serve. So usually you'll see this a lot on 4% deals just to help get those done because they usually have a lot larger debt stack. You'll see it on rural deals just because, again, they usually can't charge as high rents as other deals sometimes. Economically disadvantaged counties, maybe they want to serve certain populations, so they'll make sure that they can get those deals done. And then also properties that serve the lower income of tenants. So instead of serving, 60 area median income, maybe this one will serve 30 area median income. So again, it's usually just used as sort of incentive to get some of the deals that they want to get done in sort of their own state needs. These tax incentives usually mean that there's more affordable housing projects that they're able to get completed for each state. And so these state LIHTCs work alongside the federal to help finance the project as a way to sort of generate additional equity or proceeds from the sale of those state LIHTCs to sort of fill those gaps after your federal LIHTC equity, your perm debt or bonds, and any kind of soft financing. So it's important to note that these state tax credits are generating funding that typically does not require maybe as much debt service or payments during the tax credit period. So it makes sort of deals financially viable where additional debt just wouldn't work. So it's important to note that not all state LIHTCs are built the same. Some closely follow the federal LIHTC, while others have characteristics that differ from that in order to meet the state needs. So the varying characteristics can influence not only like tax credit equity pricing and structuring options, but also could affect the overall effectiveness of the state LIHTCs in attracting affordable housing. So it's important to know and understand these variations in order to maximize the benefits of the state LIHTCs for your particular project.
So thank you for that. I did want to just note for our listeners, as you know, Aaron, that California has had a state housing tax credit for many, many years. Years ago, created an additional allocation amount of $500 million of state housing credits. And those $500 million of state housing credits are used, they're combined with the 4% tax credit with respect to 4% bond deals in order to provide funding, to close the funding gap so that the private activity bonds could be used for new construction of affordable housing. And I mentioned that in part because that's something that many clients are applying for in California this year. But I also wanted to note that Governor Newsom, Governor of California, recently released his budget for the next fiscal year. And those credits are not in the budget for the future for next year. And that's something that many in the affordable housing community now are reaching out to the governor's office to find ways to get those credits back. It's been here for many years. Many count on it. And it's critical for building that new affordable housing project in California, that those $500 million in credits get back into the budget that all gets enacted for next year. But sorry for that side tangent. I just wanted to get that out there. So let's talk more about the many ways state housing credits do vary. And when I think about state housing tax credits and the ways in which they vary, one of the most significant ones for me, probably the most significant, and the one where as a tax advisor, we get lots of questions and there's lots of implications between them, between the two variations. And that is what I mentioned earlier, whether or not the credit is allocated, such that there's an equity member in the partnership and they get allocated the credit, or whether or not it's certificated, such that it's transferable intangible property. So if you could maybe explain it in a little bit more detail, but not too much detail, because there's a lot to unpack with certificated versus allocated credit. Maybe give a more detailed overview explanation to our listeners. Then I'll follow up with some more detailed questions about each.
Sure. So first, I'm going to start off with allocated credits, just because I feel like this is what our audience is going to be the most familiar with. So with allocated credits, you're going to have that ownership interest in the project partnership. The state credits will generate capital contributions basically as a result of the allocation of the state tax credits sort of through the partnership levels, sort of on their tax return. These allocated credits are typically earned, they have a varying duration. So you could be anywhere from like, say, 4 to 10 years. You have like California, which would be like up to 4 years. You have like Hawaii, that would be 5 years. Wisconsin, 6 years. Georgia's 10 years. So you sort of have a huge variations on sort of how those are earned. The allocated credit equity is generally regarded as non-taxable. So as long as the partners are deemed to make a capital contribution to the project partnerships and not purchase the credits. So again, that's, the purpose, sorry, of the allocated credits. One big thing to note about allocated credits is it does result in a loss of the federal tax deductions. So since the investors are actually not paying those state taxes, you're losing out on the federal deduction of state taxes. So that's something that you want to make sure you know because allocated credits, they're usually, say, corporate investor 21% tax rate. Well, it's really only worth 79 cents per credit they're getting. So that's one way to sort of think about like that's what they're worth. Also, allocated credits often have a compliance period of longer periods. So you could have like a 15-year compliance period. And also you could have, if you have any non-compliance, it's going to be very similar to the federal rules where you could have recapture. When you get to certificated credits, however, this is where you're going to have, the investor does not have that ownership interest in the projects, but instead it buys those credits outright from the project or maybe one of its participants. So they're often transferable to multiple investors with no ownership requirements. Again, that'll definitely depend on what state. A lot of times it'll be you can sell it to the first person. Maybe that person can transfer it one more time. They're usually going to have some type of rules on that, but again, it's typically transferable. But that means there's a little bit more flexibility in your investor base. Removing that ownership requirement changes also the federal tax treatment of the state credits. So certificated credits typically do not reduce the investor's federal deductions. This is because that certificate is almost deemed as a payment method for those state taxes rather than like a credit sort of as the allocated credits. So the benefit to this means that those state tax credits that are certificated basically worth $1 per credit. So again, $1 ratio. So you typically end up getting a higher purchase price with certificated credits. Also, they're usually issued like 1 year at a time or a shorter duration. So that also leads to a higher price per credit because you just don't have that discount of credits being earned and generated over a like 10-year period, for example. To illustrate this, I did want to mention I was moderated a panel in the 2023 Housing Tax Credit Finance Conference in Las Vegas in December. And during the session, I had Christine Hess, which is the CFO of the Nevada Housing Division, which is Nevada's federal and state LIHTC allocating agency. She mentioned that the sort of the 1 year certificated price for Nevada was, for example, around 90 cents. Now, you will see other states that are closer to maybe like 95 and a little bit higher. But however, when I talked to Tom Schaefer, of Senior Vice President of the LIHTC Syndicator of Venture Capital, he sort of compared that with the allocated credits, saying, if you had, say, 10-year allocated credits, pricing for that might be the low to high 50 cents range, while 6-year credits could have like mid 60s to low 70s. And that, if you have 5 years, it's going to be slightly maybe higher than that. But it sort of shows the discrepancy between, pricing of the allocated credits versus the certificated. So as you can see, certificated credits usually, maximize the credits, I think, as much as possible because you do have a little bit less of you get the full benefit and you don't have sort of that lag between when you pay for the credits and you receive the credits. So you don't have that sort of discount that you would see in allocated.
I'm glad that you mentioned the sort of pricing aspect of it because, as you know, that the fact that you're getting a nominally higher price doesn't mean that you'll yield the same amount that isn't transferable directly in terms of what the net equity is to the development. for a variety of reasons, which we'll start to unpack here. So you might, in the terms of having the maximum amount of net equity to fund construction costs, a lower price might end up generating higher net equity based upon all the various applications. So I just caution listeners to not take the initial measurement of equity pricing into as the decider in terms of the different approaches. The same thing in terms of the cost to the state budget. Obviously, a credit that's claimed over a 10-year period has less net present value cost than those same credits all claimed in year one. If it has less of a net present value cost to the state government, then it it does. It has less net present value to the investor. So there's all these issues we're going to talk about. And in the course of the podcast, we'll talk about some of the different issues that offset the relative equity pricing or enhance the relative equity pricing of the different approaches. But unfortunately, we're not going to have time to kind of go through and give numerical examples. That's a lot of what Aaron does in his consulting, is help clients identify, which approach, the timing and the rest, and structuring issues to maximize that value. And I did want to just, when you talked about the allocated credit, one thing about the allocated credit, how you lose the immediacy of that state tax deduction. And that is how everyone sort of talks about it as in sort of short, myself included. But I would just note that for our listeners, I know Aaron knows this, for our listeners, that conceptually you're losing the state tax deduction when you're using that state tax risk getting allocated to you. But to a certain extent, you're really deferring the deduction until you exit the partnership. And when you exit the partnership, say at the end of 10 years, and then you'll have whatever investments you made for that credit, then you get your basis deduction. Could get it earlier in a variety of circumstances, but it's really deferring it. And if you defer it 10 years, it's pretty much not getting it. But I would also note that that many state agencies or state policymakers understand this. So in California, for instance, California is a 4-year credit, and you could leave at the end of 4 years if you were a state credit investor only. But California limits your ability to deduct that loss for state tax purposes. So they actually push that deduction out for state tax purposes at the end of 10 years, want to accelerate that loss. So anyways, that's a lot more arcane than I plan to get into in the podcast. Feel free to reach out to Aaron to unpack that a bit. I'd like to now turn to focus a little bit more on certificated credits. And maybe you could dig a little bit deeper, Aaron, in terms of certificated credits and some of the issues you see arise when developer clients are using certificated credits.
So I think the main issue that I hear the most is that sales price that you're receiving for their certificated credits, well, it could be a taxable event for the partnership. And again, if you're thinking about just the income, just remember that this affects your federal LIHTC investors' benefits and potentially the tax credit equity pricing that you're negotiating with them. So the way to think about it is your federal investor, what they're getting as benefits, they're getting, of course, the federal credits, but they're also getting losses. So now if you have a situation where your project partnership is generating income, which is usually during the beginning of the deal, well, that's going to reduce the losses that they're going to get in the beginning of the deal and essentially defer those losses until later on. And again, with the time value of money, that's going to lead to their IRR to decrease. And if they want to try to get that same expected IRR, all of a sudden now they may, decrease basically their credit pricing for those federal credits a little bit just to get that same internal rate of return that they were looking for. So that's where that becomes an issue. However, I will say there's, many states that allow those certificated credits to be given to sort of a participant in the deal. So a lot of times there'll be a nonprofit participant. They will be instead allocated wrong word. They will be given those certificated credits, and they're the ones that actually end up selling it. And then they have to figure out the mechanism to get those essential proceeds back to that partnership. Now, that's when you got to make sure it's being structured correctly. That way, you actually have a real loan going to the actual property. Make sure it's not structured, it could be a grant, and then you have issues whether or not you need to reduce the eligible basis of your property. So there's some issues that you could run into if you're not working with somebody that understands how that should be structured. So it's just making sure that you have an understanding of if there is a situation where you're allowed to have a participant receive that and get the proceeds and avoid the income, it's just making sure you're structuring it correctly where you don't run into other issues because you're doing it that way. So it's just something that, as much as possible, just try to look in to see is there ways that you can get around, being able to take the income. And then if you are able to structure it in other ways, making sure you're not causing other issues for your partnership. Also, I will mention there's also situations where having certificated credits could cause essentially capital contributions compared to having allocated credits. And this is where, when you have these certificated credits, remember that what's being contributed or, the proceeds that are going into a deal, well, not capital contributions. So now you don't really have those additional capital contributions being generated. And if you have a deal, especially since this is used, I would say a higher likelihood on, say, like a 4% deal. Well, that deal is not getting as many capital contributions. Now you don't really get the benefit of those additional contributions coming in from the state credits because now you're just getting, proceeds or a loan, depending on how it's structured. Well, you have to pay attention to those issues when you're forecasting your property to, make sure that you're not going to run into issues where you can't allocate, the federal credits to your investors, or you may have like unexpected huge exit taxes that you're paying that's part of your option at the end of the deal. So just making sure that you're working with somebody that understands these issues. So that way, when you get to the end of your deal or get in the middle of your deal, you're not like, oh, I didn't realize that this was going to cause this consequence. So it's just making sure you're understanding how this affects everything and making sure that, you don't run into any unexpected situations throughout the deal.
That's a great point. I did a podcast many months ago about financial forecasts and the importance of the 50-year forecast and beginning with the end in mind and the rest. And this is just a good example of one of the issues that the multi-year forecasts end up addressing. Virtually no tax credit transaction gets done without a 15-year projection with the exit at the end, where you're estimating capital accounts and all the rest. And this kind of plays into that and is one of many reasons why those forecasts are so important. And then, as you point out, that you ensure that you're thinking through all these issues and modeling them in the forecast, so there aren't any surprises. So let's switch now to allocated credits. And once again, this is where the tax credit is generated by the partnership. And maybe just to build out the taxability issue that we just discussed, the concept is that the partnership is generating the credit by the activities that the partnership is engaging in. And when those tax credits are sold, when they're certificated and sold, from the IRS's perspective, that's an intangible property right that has no basis, such that when transferred, it's 100% taxable. Now, the allocated credit is when the partnership is generating this rights to this credit, and it allocates it to a given investor. And then that investor is putting equity in the partnership in exchange for getting those allocations. So Aaron, if you could describe some of the issues that arise with developments that have rights to allocated state housing tax credits.
Sure. So I think the first thing that you have to determine when you have allocated credits is whether or not you're able to bifurcate those credits from the federal LIHTCs. So I think you have to actually look to see, each state's going to have different rules. But what's important is, by what I mean is, the bifurcation is that you can actually sell these credits to different investors. So you can have one investor that gets substantially all of the federal credits, and then another investor that gets all of the state credits. And this is important because when you really think about it, there's a ton of investors that have the appetite for federal LIHTCs because there's a lot of people that are paying, federal tax. However, these different states, they sort of offset different taxes. So you have to find an investor that's actually paying enough taxes to offset in certain circumstances 5 to 10 years of taxes. So your investor pool is just going to be so much smaller for the state. So now if you have to find somebody that has the state appetite and the federal appetite, you're just not going to get as good of a purchase price. You just think about economics, supply and demand. If you have a very small pool, well, they're just not going to pay you as much. So, in order to maximize sort of the equity that you're going to get for allocated credits, you want to make sure you can bifurcate it as much as possible. Now, I'm not saying it's not going to work where it may be perfect storm and you have an investor that can take both, but there's a lot of times splitting it is how you're going to maximize what you're getting from your investors. So that's definitely something you want to look into. Also, when you do have this, remember that you're probably going to have a sort of disproportionate allocations going to a partner. So a lot of times you'll see that state partner is probably going to have, say, 1% interest. They'll get 1% of your federal LIHTCs, and then, all of your state LIHTCs. And then you'll have, say your federal investors, say 98.99%. Well, when you have that, one thing you really do want to make sure is that you're working with people that understand, does that state partner have entrepreneurial risk? Now, I will say one thing that is important here is most of these allocated credits, they have a longer lifespan. So that sort of helps with this argument. And that's why you see those not really for 1 year, you see those for more the 5 to 10 years because you sort of need to be in a deal to sort of have that risk. So that's something just to watch out for also. I think finally, one of the issues that I feel like I run into the most is sort of the issue is when you can actually take these credits. So a lot of states, they have a rule that you either have to have sort of like your form 8609 or some kind of state equivalent form. I will say there is some states, luckily, that have started changing this where you can take the credits when you have like reasonable cause that you've sort of done everything that you can. It's just that you're waiting for the administrative process essentially to take care. Luckily, I will say like this year, California for the first time is allowing reasonable cause. So that's one state that unfortunately it's effective January 1st. So I do have some 2022 credits for clients that are sort of still sitting out there, but that won't be an issue going forward. In other states like, Hawaii have had good advocates that have been able to sort of change those rules. And because they understand that a big thing for investors is when they're getting those benefits. But I will say that's where I think working with a CPA that understands a lot of these rules, because I work a lot with syndicators. So I do a lot of different states. And I can say there's definitely times where I'll get a return that flows up into, say, my tax credit fund. And I'll look at it and I'll be like, have to go back to the client and like, hey, this is missing this required form. Can you, have them provide it to me so I can attach it to our return? Only to realize they've already filed their tax return. They never got that form. Well, I know for a fact that state's going to come back and basically say, hey, here's a notice, provide me this form. If the state can't provide it, which a lot of times they're not going to provide it in a timely manner, all of a sudden now they have to amend their return only to then amend their return again once they get it back. So it's just causing some additional costs to that project partnership. So it's making sure you understand those rules because there's a lot of times I feel like I'm just holding on to a whole bunch of sort of these tax credit funds, just waiting to see, are we going to get this by 9/15 or 10/15, depending on when the states do. So it's definitely important to know work with somebody that understands those rules because there's a lot of states that, I mean, it's almost an automatic notice because they're going to, as soon as they see credits, they're going to check in their system and say, well, have we approved this? They usually have some kind of database that they're double checking. So, and also it's really good to understand when you can take these credits because you want to make sure your investor understands when you are actually going to be giving the credits to them. Because if there's like, for example, this year, I've already filed 2 Georgia returns that were for 2021 and 2022. Now, if the investor originally thought that those credits were actually coming then, that's just going to cause some issues because they're going to be like, well, wait, this return in 2021 didn't have credits. Well, we're giving it to them now in 2024. So just sort of getting a good understanding of those kind of roles.
So in dealing with allocated credits, you kind of noted how a critical question is it bifurcatable or not? And then if it is bifurcatable, then you'll have a separate state investor and a separate federal investor with separate capital accounts and the rest. Maybe you could describe some of the structuring issues you know how you deal with when you have allocated state credits.
Sure. So again, I can't probably get into too much detail just because it does get, can get rather complicated, but I would say there's probably three typical structures that I end up seeing. So you could have a state partner that's actually in the project partnership level. And again, it's just they're usually say the 1% partner. It's not always exact, but I would say that's what I probably typically see the most. And then your federal investors and you get 98.99% of the credit. So still substantially all the credits go to them. Um, there's definitely situations where they'll put a sort of middle tier entity in between the lower tier and the upper tier. And so a lot of times this is made so like all of your capital contributions are coming from, say, one investor, which is that middle tier entity. And then everything gets split at that point. Again, a lot of times this is done for capital count reasons. It can get relatively complicated. So it's hard to sort of explain it all on here, but it's just making it so those allocations, they don't have issues throughout the, tax credit period. And then you could also have situations where it's just both the state and federal partners are sort of at that upper tier level and they're just sort of in the fund. In a lot of situations like this, it could be that they're the same investor, or it still could be that it's bifurcated and there's just state partners in the deal, federal investors in the deal, and everything just sort of gets split at that level. So again, it's usually just depends when you're sort of doing that forecast, when the syndicators doing their forecast. It's just like what sort of structuring option makes the most sense to sort of deal with the issues that you're going to have on your particular deal, and it's just sort of deciding which one works best. Because again, there's no just one option works in all situations. It's always okay. I need this kind of situation. I need this kind of structure for our situation, but then the next deal you do, it could be something completely different. So it's just making sure you're understanding the economics of your deal to make sure that you're structuring it where you're going to sort of maximize your benefits and sort of mitigate some of those risks throughout the period.
Yeah, thank you for that, Aaron. And I do want to also just note for our listeners that there is I'll call it a pesky tax issue out there with respect to allocated state tax credits, particularly when you have a separate investor. And that is whether or not it's a disguised sale. The state tax credit I mentioned earlier is conceptually under federal income tax law considered intangible property with zero basis. When you have a state tax credit investor, they're getting the distribution of those state tax credits. The question is that a property distribution every year that the credit's being generated, such that they're the equity investor getting a property distribution, or since they put capital in, you get a property distribution back under the tax code, is that treated as a disguised sale, as if they really bought the credit? It's treated more like a certificate of credit. And it's something that there have been tax court cases years ago that dealt with one-time state historic credits that this was recharacterized as a disguised sale. There's a lot of thought that since low-value tax credits are on the run credits in the sense that you get them every year for a number of years, and the investor sort of comes in during the development phase, that any sort of presumption that some portion of that treated as a disguised sale should be rebuttable. But it is something that will give your tax attorneys a little bit of a headache. It's something you should be mindful of in the course of structuring, but that's well beyond the scope of this podcast. But one thing that's not beyond the scope of this podcast, Aaron, that you and I discussed when we were preparing for it, is something that really does affect the value of state housing tax credits pretty directly. And that's something that you made reference to earlier, and that is what types of taxes can be offset with those credits. If you could unpack that comment a little bit more, I'd appreciate it.
Sure. So this is where you definitely have to dig into each individual state and understand what kind of taxes you can actually offset. So you could have states that you could do individual income taxes, corporate income taxes, insurance premium taxes, insurance retaliatory taxes, maybe corporate franchise taxes, or just many other types of taxes, and they're all going to have sort of different rules. So you really do need to know what your state allows, because those are the types of investors that you need to find is the ones that actually pay those particular types of taxes. I will say one thing that I found, interesting is, there is, you might think like, okay, what happens when you deal with a state that doesn't have an income tax? Well, when I was doing the panel in Las Vegas, I was able to sort of discuss with Audra Hammernick, the president and CEO of Nevada Han, that, in this case, Nevada, they do not have the state income tax. So in that case, their state LIHTCs offset like gaming and licensing fees, insurance premium taxes, and then general business taxes, which are usually payroll taxes. So for them, it's very important, like the bifurcation part, it's very important that they can sell those credits to other people, because if you have a federal buyer, are they really going to have payroll consequences in Nevada? Are they going to have, gaming and licensing fees or these insurance taxes? Maybe not. So it's very important that in their case, they can sell these state tax credits to the individuals that actually have those particular types of taxes, and then be able to still, allocate the federal LIHTCs to another investor that actually, will pay a higher price for those and not have to worry about finding somebody that has both. So
Yeah.
it's definitely good to understand, what state takes what. And it's interesting that there's a few states that don't have, those income taxes that still have state LIHTC. So it sort of proves that it can work in any state as long as they're flexible.
No, thank you for that observation, because that is something that people hear. Nevada, for instance, are like, well, they don't have a state income tax. How can they have a state housing tax credit? Well, here's how. Uh, Something that I should have mentioned earlier, and this is for our listeners, on Novogradac website, novoco.com, we do have a page that lists the states that have their own state tax credit. We have a map, it's shaded, and we also include some of the basics about those state tax credits. I will share a link to that page in today's show notes. I'd also suggest that if there's something on the website that has been updated, please email CPAs at novoco.com. We're constantly working on the page to try to keep it current, but with 50 states constantly passing legislation and the like, or at least those states that whether a state legislature meets every year, there's definitely parts of it that can be dated. So we are constantly reviewing it ourselves, and we appreciate the feedback through crowdsourcing that users of our website can provide us. And that actual request for comments goes anywhere else. If there's ever something on our website you're looking for that you can't find, email CPAs at novoco.com, and we'll see to what extent we can access it, put it on our website, because if you need it, someone else probably would like it too. But speaking of our map that lists, the 30 states with state housing credit, made me myself think of, well, what are the ways in which a state can increase the value of their state tax credit from a design perspective? So maybe, Aaron, you could share some of your thoughts as to how states can do that. Because obviously, if you increase the value of the state tax credit to investors, increase the net equity to the development, which means you can close larger financing gaps and fund more developments.
Sure. So as you mentioned, there's, 30 states with credits. I think it's technically 29 states in the District of Columbia, but they're often adjusting their credit because they're trying to meet their needs of their state. So, I think you can advocate the sort of, you know, the different characteristics that you want in your particular state to try to increase that investor demand, because again, they want to make sure they're maximizing their state credits. So anything to sort of increase that investor demand, I would, think that a lot of states would definitely be listening to see, what they can do. So I think one thing that we've mentioned a lot is just that bifurcation of credits. Definitely make sure that, you're working to be able to sort of sell those federal credits to and state credits to a different investor. If you have to sell it to the same one, again, it's just economics. I mean, if you just have a smaller credit or investor pool, unfortunately, you're just not going to be able to, potentially get as good of a price. I think another big thing is just having that sort of optionality is the more taxes that state LIHTC can offset, again, that's just, again, increasing your investor pool. The more, investors that want to use those credits, the higher price you're going to end up getting. So if you can find, if you can get them to do individual, corporate, all those ones I mentioned before, again, it's just the more credits or more taxes, sorry, that it can offset, the better it becomes. And also just, having one that you're able to having that transferability, just making sure you're able to, transfer that credit to the basically investors that need it at that time. Again, just going to help increase that purchase price. Also, another thing that you're going to want to deal with is trying to make sure that as many details as possible is going to be in your qualified allocation plan, which sort of governs the administration of the housing credits in the state, and have a little bit less in the statutes. Um, this is just because, that QAP, the qualified allocation plan, well, the state typically goes in there and actually updates it each year, sort of based on the needs of their particular state. However, if it's in the statutes, now you have to wait for them to pass a bill. And again, it's not, even if it's something that makes logical sense that they really want to get done, it doesn't mean it always gets done quickly. So again, you're going to want to probably put things like the ability to, like, say, pair 9 and 4% credits, the geographical distribution between like rural and metro areas, application scoring that sort of mirrors the federal program, minimum allocations per development, and those kind of things is what you're probably going to want to put in the QAP. I will mention that, like, again, another thing that I learned in my panel is Christine Hess, again, with the Nevada Housing Division. Well, she had found a deal that just needed state LIHTCs, thought it was a perfect deal, and then realized it had a land lease. And unfortunately, in their statutes, it said it must be a fee simple sale and they must own the land. So she actually ran into a situation where all of a sudden she realized the statutes wouldn't let her give it to a property that she really thought, like, this property needs to get done. It's going to meet needs of their state. And all of a sudden she actually couldn't use those state LIHTCs for that property. So that's one of those situations that, if you put certain things in the statutes, it's just going to be difficult to get some certain deals done. So it's best to just let the market decide what's best. Whatever you can get, sort of that, higher purchase price from the investors, whatever you can create the most demand, that's definitely going to be what you want. I will mention that if you are going to advocate, the Affordable Housing Tax Credit Coalition released their recommendations for practices and considerations for state LIHTCs that they released, I believe, in October of 2023. So definitely, if you're going to do it, that might be an also document for you to look at.
Great. Thank you for that, Aaron. And let me also just provide a general sort of disclaimer qualification. I'm not quite sure what to call it. And that is that Aaron and I periodically have made references to kind of selling the credit. And I would just note that when we're dealing with a certificated credit, we're actually talking about selling that tax credit. When we're talking about an allocated credit, we're talking about selling equity in the partnership that would then be allocated the credit. So just want to be mindful of that. And then before I close, though, is there anything else, Aaron, that you wanted to share with the audience about state and local housing tax credits?
So I think again, I just want to sort of keep sort of mentioning that, just note that every state is different. So if you're dealing with a new deal in a different state, just don't think that it's going to be just like the last state that you dealt with. Just make sure you understand early what each state does, what kind of, how the credit works, what's the mechanics of it, what issues could arise during the tax credit period. Just make sure you're understanding that so you don't run into any issues during your tax credit period. If you have any questions, always feel free, you can reach out to me. And then also, always like, again, I'm referencing a lot, like the panel I did. So there was a lot of good information that was shared there. So always feel like, I'd say we have an affordable housing conference coming up in May. So I would say definitely consider going to San Francisco for that. Um, but yeah, I would say just main thing is just really make sure you understand your state, make sure you're working with people that understand that state. So that way, your deal can sort of maximize the benefit out of these state credits and you don't run into some unforeseen issues.
Right. Thank you for that. And I also second your invitation to our audience to the Novogradac Affordable Housing Conference. That'll be May 2nd and 3rd in San Francisco. And I will share Aaron's email address in today's show notes, as well as links to the conference and the state housing tax credit pages I mentioned earlier. And I'll also share the links to the other episodes in our So You Want to Be a LIHTC Developer series, and a link to my column in the January issue of the Novogradac Journal of Tax Credits that also discusses state tax credits. And then, though, one other thing before moving to our off mic section, I wanted to share a reminder to our listeners. Please take a moment to like and to subscribe to our podcast on whatever platform you use to listen to or watch this podcast. By liking and reviewing the podcast, you help others find it. So now let's turn to our off mic section. And this is where I get to ask some non-tax credit related questions, or at least not directly tax credit related questions of my guests. And Aaron, my first question for you, and it's certainly a favorite of mine, if I'm not also a fan favorite, is I'm always looking for productivity tips or productivity hacks. What is one of your favorite productivity tips or hacks?
Since we're in sort of our busy season, I think this is one of the things that it took me a little while to learn is to, as much as possible, concentrate on one thing at a time. When you're in busy season, I mean, you're constantly getting emails, you're constantly getting, hey, you need to do this, you need to do that. It's being able to sort of concentrate on one thing, accomplish that, move on to the next, and be able to sort of concentrate on one thing and don't let all the little things almost overwhelm you. Because I think a lot of times when I see new staff and seniors, sometimes it's just the amount of things that are coming in, especially during busy seasons, can almost overwhelm you. So I think it's a really good thing is to sort of have a mindset is I'm going to accomplish this real quick and then I'll move to the next thing. Because if you're trying to work on too many things at once, number one, you're not going to be efficient. And again, you're just not going to get all those things accomplished. It feels good to be able to accomplish things throughout the day. And if you're just working on everything, you may not accomplish anything.
No, very good advice. It kind of reminds me of Stephen Covey and his concept of there are things that are urgent and not urgent, and there are things that are important and less important. And in busy season, there's a lot of urgent stuff. And focusing on the urgent important is critical to proceeding. And that's some of what you're sort of suggesting there. Another question I like to ask guests is what they know about leadership now that they didn't know when they finished college. What are your thoughts there?
So I think when you're in college, I think you're just picturing that person in the corner office that's just directing everything. Where I think now that, I'm the one person that's sort of leading my team, I like to think of it more as I'm working with them. I'm not just sort of like sitting above and telling them everything to do. Like I want to make sure there's constant communication between me and my team. You're leading by example. You're sort of being able to sort of show that, again, you're not above them in any way. You are just you're just all working towards that same goal and just trying to get things out. So I think just having the more of a team aspect and making sure, you're having sort of constant communication with your team and you're working with them. So that way, I think everybody gets a sort of, gets that benefit is when you meet all of your goals, you meet the deadlines, everybody's happy because they know that everybody had their part.
Well said. And you're a living example of that. So thank you, Aaron. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac & Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac & Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.